Hi, Andrew. This is John Morgan. Been talking to you on Upwork because you were looking for somebody to do some live education with some of your clients. I don't know if that's all trade analysis or if it's just technical analysis basics, but um, I wear this every day to work. I always wear a suit. I work from home. This is my home office. Looks bare in that corner, but uh, I always dress for work. I learned the hard way that if I don't dress up for work, working from home, I have a hard time believing that I'm at work. So this is what I would be wearing. I do not wear this at 8:49 in the evening normally. I usually switch out into usually shorts or well, I'm in South Dakota. It's usually pants and a sweatshirt. But anyways, the one of the topics that I kind of wanted to go over as an example of what I would discuss. I'd probably like to discuss divergences. I have found when I've taught other people and discussed how the market moves and how to analyze markets, that divergences are something people find really interesting and they kind of like to see it. Um, and so if I'm talking to you as a student or your group, I would, start off by saying that, divergences are signals that there's going to be some type of change happening. And, you can use a number of different oscillators. For today, we're going to use the RSI. RSI is pretty popular. A lot of people know it. It is one of the greatest indicators out there. Guy by the name of J. Wells Wilder created it. And the problem with it, though, is that new traders, they understand the concept that if you look on your screen that, you know, above the 70 area is considered overbought, under 30 is considered oversold. And that is true. It's just how you implement it, because looking at past price action, it's really easy to say, well, okay, if we're deep into oversold territory, why not just buy it, right? Because that's just going to equal money. Well, I'm sure everybody who has tried trading has tried that and lost money doing it. The RSI should not be used like that. You need to have other tools to confirm that there is going to be a change, and that's where divergences come in. All right. So there's two kinds. We've got regular divergence and we've got hidden divergence. Regular divergence, like regular bullish divergence, means that price is going to change direction from going down to going up. And how we notice that, we need to find a little bit of a down trend somewhere. Okay, like right here, this is a perfect example. Oop. So regular bullish divergences, in price, we want to see some lower lows, all right? But on the oscillator, we want to see higher lows, okay? And the kind of rule of thumb is that you want to look for a series of three. That doesn't always have to happen, but we want to see a series of three. So if we look here, we see we do have a series of lower lows, low 1, 2, 3, lower low, but on the oscillator we have higher lows. What this is telling us is that this move further down, there's not a lot of conviction in it, all right? There's just not a lot of momentum. There's a lot more momentum moving up, and we can kind of see that on these volume bars here. As we get to these lower areas, we see these volume bars increasing. That's another type of thing to learn about, but just for divergence purposes, we do see these increasing lows in the oscillator and the decreasing lows in price. And because we are in a little bit of well, it's probably mostly a flat trend, but it is going down, but then price likes to respond and move to the top. Now the inverse of that is bearish divergence. And if you are trading shortable instruments like Forex or futures, then bearish divergence is great. For trading cryptocurrencies, because they're really not a shortable instrument for a lot of people, then bearish divergence can be used as a signal to exit your long, or a signal to not take a trade to go long. So regular bearish divergence means that we're getting higher highs in price, but lower highs in the oscillator. All right, and we can even see that actually. Again, that's going to show up at the end of a move to the top, which here's a great one. It's right next to it. All right, so we have, this isn't a series of 3, but these are 2 pretty standout wicks. Regular bearish divergence. Okay, higher highs in price. See? Also, look at how the volume bars correspond to these areas. Spikes in volume. When you see volume increase, they always say volume precedes price. So whenever you see price increasing in an uptrend or volume increasing in an uptrend, that's one of your first signals that it's not going to keep going that direction. So we see higher high, lower high, and price does move to the downside for quite a while. All right. Now, hidden divergence. Hidden divergence doesn't mean that it's sneaky like a ninja or that it's difficult to find. Hidden divergence is, excuse me, it's water. My bad. Hidden divergence means that a trend is going to continue. So where you saw regular divergence here on a regular bullish divergence means that price is going to stop going down and going to reverse up, and that regular bearish divergence means that price is going to stop going up and start to go down. Hidden divergence, that means that the price is going to continue. So for a lot of traders, sometimes you don't even know you're in a trend, but let's say price is moving up, and you just think that, okay, it's got to come down sometime soon, and it sells off a little bit, comes back up, and that starts to sell off a little bit again, and you think, okay, you're not going to miss the boat this time. This is the time to go short. Only then you get stopped out. Price keeps going up and shooting up. That's probably because you've been the victim of some type of hidden divergence. Not all the time, but it certainly can be. And so an example, a hidden bullish divergence, that means that price is making higher lows, but we're getting lower lows on the oscillator. All right, so, that's nice. We have some higher lows and in price, and then we have lower lows in the oscillator. Okay? Now, one thing I want to point out, because somebody might see this if you don't see it before I say it, or if you do see it before I say it, congratulations. But we also have within that move regular bearish divergence. All right? So, looking at this, what does that mean? That is not a fun thing to trade. That is a chop zone. That is, a lot of indecision happening. That's something you don't want to participate in. This is where traders go to die. This is where their accounts get massacred. Actually, any consolidation zone is where traders get massacred. You get in and out and in and out, and you start over trading. So, here's an example of that bullish divergence. With the higher lows and the lower lows in the oscillator. Those are a sign that the trend is going to continue, which it didn't there. It just kind of flattened off a little bit. The inverse of that is hidden bearish divergence, and that's where we're going to get a series of lower highs in price, but higher highs in our oscillator. And you're going to notice that in a in a downtrend, which we may have to zoom out a ways to go find one. Okay, let's see here. We'll probably find one here. So it's a sign. What that generally means is that this is bearish divergence is like when people think that they're going to go long, and that they're going to be able to find the reverse in the trend, but it doesn't, and price just keeps going lower. So we want to look for lower highs in price, but higher highs in the oscillator. All right. We're getting some bullish divergence here. Sometimes, especially in cryptocurrencies, these are difficult to find. Hidden divergences in general are difficult to find in cryptos because they're not a shortable instrument. So we want to find some lower highs in price but higher highs in the oscillator. Well, actually, this might be a good as we're going to get for right now. Some lower highs, and you can see kind of how a person might think. This is more flat, but sometimes flat can be considered, to fit your divergence criteria. But you can see probably why people here are thinking about going long, because we do have some participation in volume, and it looks like we have a lot of bullish candlesticks here. This looks like it's firm rejection of this this engulfing bearish engulfing candlestick. But then as we get up to the top here, we notice that and in the middle of all this we have regular bearish divergence as well. If we kind of zoom in a little bit. So we have two really nice confirmations that price is not going to stick around here. Not only is the oscillator oversold at these levels, but we have two really nice confluencing bearish indicators. So that's a great way to avoid getting into a trade that's going to stop you out. Those are, so I mean, that's just one example of something I talk about. I'd be a little bit more prepared with having a lesson in probably some of these levels drawn out instead of trying to search and find them just live. But I hope that this is the kind of thing that you would need, and let's visit later on this evening or tomorrow if you would like to. I can be reached anytime between generally 5:30 in the morning and now. I'm always working. I love what I do. So have a great evening, and talk to you later.